Keyman Insurance Corporate Protection, written by Adrian C. Spitters and Peter J. Merrick of the Merrick Spitters Reset Report, narrated by Peter J. Merrick. Key person insurance provides the insured and a corporation with a classic win-win. It represents potentially money-saving protection and crisis resolution for a client's company with vital key executives. Key person policies fall into three main categories: life insurance, disability insurance, and critical illness insurance, which amount to a specific use of otherwise standard policies in these product categories. A key person insurance policy provides a clear mechanism for handling a shareholder's interest in the event of his or her death. It provides an assurance that his or her estate can resolve the sale of a company stake more easily than otherwise would be the case. That in turn eases some of the pressures of succession planning in a time of crisis. A key person disability or critical illness policies provide cash payouts to assist in replacing a disabled or critically ill executive, in effect also easing a potential crisis. Key person insurance also provides tax planning tools and under certain circumstances allows the individual to use up to 90% of the cash surrender value of the policy as collateral to secure personal and corporate loans for shareholders. There are also increasing choices in available investment options in universal life insurance, where these investments compound tax-free within the policy. However, this positive picture has some limitations. One factor that might discourage implementing a key person insurance policy are the tightening of underwriting restrictions due to factors such as executive travel to troubled areas such as the Middle East or just poor health. Moreover, potential sales vary between executives of different sectors since the economic recovery has varied between sectors. In a familiar use of the key person concept, a buy-sell insurance policy provides a company with the necessary funds to buy out the ownership interest of an individual shareholder when he or she deceases and the interest passes to another shareholder or to heirs. Key person life insurance provides a relatively inexpensive means of covering costs of replacing a deceased executive and reassurance to the company's stakeholders, sending the message that can satisfy lenders, other corporate creditors, and suppliers that the company has covered off on conceivable emergencies and factored in contingencies. The process starts with assessing the insurable interest represented by the stakeholders' participation in the company and then explaining that to the client and the insurer's underwriter. For key person insurance, the insurable interest consists of the individual's salary, the individual's impact on the company's bottom line, and the cost to replace him or her on death. To illustrate this, let us imagine a situation in which an executive earns $200,000 annual and contributes $2 million annually to the corporation's bottom line. If he or she were to die, the company would likely contract a search consultant to find a suitable replacement at a cost of $60,000 in professional fees. In previous situations, the replacement needed 18 months to reach the same productivity level to meet the company's current bottom line, leading to an indirect but nevertheless real cost of up to $300,000 in salary paid during that period and up to $3 million in lost productivity. Therefore, it may cost this company upwards of $3,360,000 to replace the deceased key person. That figure amounts to the insurable interest that needs to be presented to the insurance company that is underwriting the key person life insurance policy. Compare those figures with the cost of a key person life insurance policy. Providing $3,360,000 in life insurance coverage on a 50-year-old male non-smoker is roughly $5,000 in annual premium cost, or 0.0015% of the total potential liability. These figures are approximately scalable, meaning that they can be multiplied upwards or reduced downwards in proportion, although rates are subject to change and vary between insurers for similar coverage. That makes for easy calculation of premiums in relation to insurable interest. In situations in which company decision makers find the cost of key person insurance unacceptable, they can opt for self-insuring against a future crisis, like having lines of credit available. But in the event of premature death, disability, or critical illness, the cost of owning insurance is a fraction of the price compared to other options, and the most cost-effective way to mitigate those financial risks. Whether your practice or your clients are considering key person coverage, a buy-sell agreement, or both, it is important that the documents and insurance policies be reviewed periodically to ensure that the valuation formula is current and that the insurance is adequate to fund the potential risks. This should be done at least once every 3 years, or if there is a major change occurring within your firm or your client's companies. To receive your updates on what is happening in the world of finance by signing up to the Merrick Spitters Reset Report by going to merrickspitters.com.